Welcome to The Explainer. Today we're diving into a fascinating and frankly kind of terrifying story about the year 2026. We're going to unpack how one single sudden geopolitical shock basically ripped the band-aid off the entire global economy and exposed all its hidden fragilities. I mean, 2026 started with just sky-high confidence, right? But it quickly revealed an economic system that wasn't nearly as bulletproof as we all thought. Now, this is a seriously complex web of data we're looking at, but don't worry, we're going to break it all down step by step so you can see exactly how these pieces fit together. Okay, let's dive into this. Back in January of 2026, the Atlantic Council dropped a pretty stark warning. They said, markets are confusing resilience for immunity. Now, at the time, this was a wildly contrarian take. Forecasters were just incredibly optimistic. Inflation was finally cooling down, AI investments were absolutely surging, and the S&P 500 was hitting all-time highs. Wall Street analysts were basically declaring the global economy totally immune to any major shocks. But, as we'll see, that bright optimism was completely shattered, and this warning ended up reading like absolute prophecy. So here's our roadmap for today. We'll start with the illusion of immunity, then move into the strait that changed everything, followed by the AI capex reckoning. After that, we'll look at debt, deficits, and stimulus, dive into the payment architecture war, and finally wrap up with running out of runway. All right, Chapter 1, The Illusion of Immunity, False Optimism in Early 2026. Chapter 2, The Strait That Changed Everything, The Energy Black Swan. The sheer speed of this event is what caught markets completely off guard. In late February 2026, war broke out involving Iran, and then, bam, on March 4th, following military strikes by the US and Israel, the Strait of Hormuz, which is a massive global choke point, was effectively closed. Just 4 days later, March 8th, the price of Brent crude surged straight past $100 a barrel. The International Energy Agency actually called it the largest supply disruption in the entire history of the global oil market. Heading into the second quarter of 2026, this one single event yanked close to 20% of the entire global oil supply right off the market. $126. That was the peak price of Brent crude oil per barrel right after the closure. This was a massive, out-of-nowhere data shock to the global system. And sure, paper futures markets briefly calmed down after a temporary ceasefire was announced in April, but the physical, on-the-ground reality, it was so much harsher. Delivered crude to Asia was still trading at a staggering $132 per barrel. This huge divergence sent a very clear signal. High volatility, not some swift, meet resolution, was the new baseline for the global economy. Naturally, the macroeconomic impact was immediate. 3.1%. That's the IMF's heavily downgraded global growth forecast for 2026, way down from their much more optimistic earlier estimates. And this drag is being almost entirely driven by the twin pressures of this conflict-driven energy disruption and a really persistent fragmentation of global trade. And keep in mind, that 3.1% is just the global average. Depending on where you are in the world, the reality is actually much, much more severe. Take UNCAD, for example. They estimated an even steeper drop, down to 2.7% for the global economy, which is significantly below the pre-pandemic average of 3.2%. And they point out something absolutely crucial. This brutal, immediate hit is disproportionately hammering the developing world. I mean, think about it. Many of these developing economies were already constrained by heavy debt burdens and really limited access to affordable finance. So for them, this isn't just some temporary headwind, it is a full-blown structural crisis. And here is where an abstract energy shock instantly translates into a literal survival crisis. The knock-on effects go straight from the gas pump to food security. It's pretty straightforward. Energy costs transmit directly into fertilizer costs, which then actively drive up commodity markets. The Kiel Institute estimates that global food prices could rise by up to 2.7%. And get this, that risk actually doubles if Saudi export pipelines get hit too. This creates a severe food security crisis for sub-Saharan Africa, South Asia, and parts of the Middle East. You have nations like Ethiopia, Kenya, and Senegal suddenly absorbing a devastating economic shock that they literally had absolutely no part in creating. Moving right along to Chapter 3, the AI Capex Reckoning, Extraordinary Numbers, Narrowing Margins. Now, what's really interesting about this is how heavily the United States economy was leaning on artificial intelligence in early 2026. It was almost dangerous. AI-related investments accounted for a staggering 67% of U.S. annualized GDP growth. That leaves just 33% for literally all other economic activity. The enthusiasm was just totally undifferentiated. Everyone was pouring money into absolutely anything with an AI label slapped on it. But as the broader macroeconomic environment tightened up because of the energy shock, the margin for error in the tech sector virtually disappeared overnight. The result? A really sharp divergence between the companies actually making money and the ones just surviving on borrowed time. Consider Microsoft Azure. They posted 40% growth, hit a $37 billion AI revenue run rate, and completely justified their massive $30.88 billion quarterly capital expenditure. They are successfully monetizing AI. On the flip side, think about Oracle. In late 2025, they had to sell $18 billion in bonds just to fund their infrastructure. And how did the market respond? The stock fell 5.6% the very next day and eventually lost a third of its total value. With Meta, Alphabet, and Oracle facing $86 billion in debt issuance obligations for 2026 alone, investors are getting ruthless. They're drawing a hard line between proven infrastructure providers and speculative AI ventures. All right, Chapter 4, Debt, Deficits, and Stimulus. Spending into the storm. So as central banks like the Bank of Japan and the European Central Bank step back from bond markets to unwind their balance sheets, all this record sovereign debt is just being dumped directly onto private investors. And guess what? Those private investors are demanding much higher yields to take on that risk. And this brilliantly illustrates the severe mismatch between political stimulus logic and actual economic coherence across the G7. In the US, they're projecting a massive 5.5% fiscal deficit, while economic growth is just crawling along at 2%. That is simply not a sustainable recovery strategy. Meanwhile, Germany is ramping up defense budgets even though their economy is expected to contract. In Japan, they're running their largest peacetime fiscal expansion in a generation despite their debt levels sitting at literal century highs. Across the board, governments are loosening the fiscal taps at the exact moment bond market patience is running completely thin. The consequences of these choices are profound, especially when you look outside the G7. To ground this somewhat abstract concept of treasury yields, let's think about it this way. When private investors demand higher yields to absorb all these massive US and European deficits, financial conditions tighten up globally. This reduces capital flows to emerging markets, it strengthens the US dollar, and it makes dollar-denominated debt incredibly expensive. As Nexdel Intelligence points out, the G7's domestic fiscal choices trigger capital flight and currency depreciation across the entire developing world. It's a massive ripple effect. Which brings us to Chapter 5, the Payment Architecture War, Wallets, Currencies, in the New Geopolitics of Money. This is a structural war that is heavily underreported. Non-dollar payment systems are deploying globally at an astonishing rate. By mid-2026, nearly three-quarters of T20 nations are engaged in tokenized cross-border payment systems. China and India's platforms, they're already live. Brazil, Russia, and Australia are actively building theirs out right now. And notably, the BRICS platforms are explicitly designed to bypass traditional US dollar-based correspondent banking. The US is trying to reassert influence, but it's a moving target. And what's fascinating is that the Hormuz energy shock actually accelerated this trend dangerously fast. When Gulf oil exporters suddenly needed to invoice buyers in alternative currencies because of dollar payment disruptions, this exact alternative infrastructure was suddenly ready and waiting to be used. And this architectural shift presents a massive, massive opportunity for the developing world. Take the Pan-African Payment and Settlement System, or PAPS. Currently, remittance flows, which, by the way, are a huge source of external finance for African economies, are trapped in these slow, expensive correspondent banking corridors. But PAPS is positioned perfectly to benefit from this tokenization wave. It allows intra-African trade and remittances to bypass dollar conversion entirely. For African central banks, engaging strategically with these new payment ecosystems isn't just about saving fees, it offers a genuine path to trade sovereignty and immense negotiating leverage. Finally, Chapter 6, Running Out of Runway, the Compounding Feedback Loop. So, the crucial point we really need to understand here is this compounding feedback loop, because no single shock was fatal in isolation. Step 1, we had these deep, pre-existing structural weaknesses just building up. Massive AI tech debt, reckless sovereign deficits, and fracturing payment rails. Step 2, we introduce a massive, sudden geopolitical energy shock with the closure of Hormuz. And then Step 3, all of these variables compound simultaneously. The energy shock reactivates inflation, which forces higher debt yields, which then crushes emerging markets, which in turn accelerates the move away from the dollar. It is just a perfect interlocking storm that tips the entire global system. Which leaves us staring at this ultimate, frankly provocative question. Can policymakers in Washington, Brussels, Beijing, and across the developing world coordinate credible responses before the runway runs out entirely. The window for strategic positioning, whether we're talking about securing AI infrastructure, adopting new payment systems, or enacting some actual real fiscal prudence, that window is open right now, but it is closing fast.
I want to leave you with a final thought that really perfectly summarizes this entire crisis. Resilience is not the same as immunity. The global economy is about to learn that distinction at scale. We spent years, decades really, assuming the economic system could just bounce back from anything. But as 2026 is proving, when all the foundational cracks are hit at the exact same time, you aren't immune. Thank you so much for joining this explainer, and as always, keep questioning the data.